Hello and welcome to the Move Up and Move Down Masterclass. I'm Dave Boswell with Main Street Home Loans. In the industry for 30 years, helping my clients make the most informed financial decision when it comes to purchasing a home or refinancing their home. Today, we're going to talk about strategies to unlock equity and clarity, moving from the emotional paralysis of the low rates that you might have on your current home to data-driven decision making. So let's go ahead and jump in. Most of the homeowners that I'm speaking with lately are feeling very stuck in their situation with such low interest rates, in some cases down as low as 2.5% to around 5%. Given the fact that rates are in that low 6% range, they're asking themselves this question: I have such a low rate, should I just stay forever? But at the same time, we need to change. We need to do something, but does it really make financial sense to do it? And so this is what we're calling the locked in effect, the emotional clash between holding on to those low rates and the need for lifestyle change. We must shift from feeling the market to modeling that outcome, which is what we're going to talk about today. So the natural progression when buying a home is you're going to find your first home when you're young, you don't have any children, maybe you're married, and it's going to be a townhouse or a condominium. It's a starter home, and it's not intended to have a full family. It might be in the city versus the suburbs. So when you are in that situation where you're now building a family, you're having kids, you're going to want to move up. You're really just outgrowing the property, and maybe it's not in the school district that you want for your kids. So your natural progression is to move up into a larger home. And this is a lifestyle shift. It's also long-term positioning because you're moving that asset or that equity into a newer home, a bigger home, and it's going to serve the purpose of the children. It's going to serve the purpose of your lifestyle. So the other path is once you have your kids go off to college and they move out of the house, you're ready to now move down. You don't need the big space. You don't need the electric bill that comes with the bigger home. You don't need the yard that you have to mow. And so there's a lot of lifestyle changes that you will naturally move to that won't require you to be in that big house anymore. So the locked in effect is having a real strain on the system, the natural system here, where you do need to move down or you need to move up, but you're holding yourself hostage. You're handcuffing yourself to these low rates when really you should be looking at the relocation of net worth and whether you put that money into the home or you put it somewhere else. We have to start thinking about our equity strategically, not as just equity that's trapped in the home as cash. We got to think about things like debt elimination. We have to think about asset diversification and retirement liquidity. What we're going to do is we're going to walk through some examples, some scenarios in both the move up and the move down perspective so that you can kind of get a sense as to how to think about this strategically. So before we get into the scenarios, let's talk about the right sizing tax shield. Whether you're moving up or you're moving down, you do have a tax exemption up to $250,000 as a single filer, married filing jointly is 500,000. We're going to get into a little bit more of the nuts and bolts about how this is calculated in a couple slides from now. But wanted to also talk about the ownership use test. You have to have owned the home for at least 2 years, and you must have lived in the home as a principal residence 2 out of the last 5 years, but the 24 months does not have to be consecutive. That's a really important point. Exemptions and frequency, there is prorated exclusions available, like circumstances of health, job change, divorce, and these can be claimed once every 2 years. Let's talk about this a little bit more in detail, maximizing profit via the cost basis. So what is your tax exemption? But before I do that, I want you to understand that I am not a tax advisor. It's always a wise decision to seek the advice of a CPA, someone who can actually calculate this exemption for you. But for the most part, it's profit equals sales price minus the purchase price of the home plus the cost that you incurred by buying the home plus any capital improvements. And what we mean by capital improvements is that it adds value or it prolongs the life of the home. Examples could be new roof, new deck, room addition, landscaping, HVAC, things of that nature. Repairs, on the other hand, if you're just painting the room or you're patching a roof, fixing a leak, does not count as a capital improvement. That's more wear and tear, which is expected. So, the biggest warning here, or at least a warning, is that there is a recapture on depreciation. If you're claiming a home office deduction, things like that, you're going to want to subtract that out so that it's not part of your maximizing profit. So, okay, so let's talk about this even further in scenario A, the strategic downsize. In this example, we have John and Jane who bought their house in 1990 for $250,000, but they're selling now for $875,000. So their purchase price back in 1990 plus costs was 262,500. So that's the cost basis plus the cost of buying the home. And then over the years, they had remodeled their kitchen, their bathroom, the roof, which cost about $85,000. But they also have to take off of that depreciation recapture of $50,000. So their adjusted cost basis in this scenario is 297,500. So when you subtract it from the gross profit, in this case, the gross profit is $820,000 after commission and other expenses. So you're left with $522,500. And as a married couple, you have the $500,000 exemption. So your taxable gain here is only $22,500. So the question now becomes, as this is the strategic downsize, do you put all of that money into the new house, perhaps not have a mortgage payment? In some cases, that might work to your advantage. In other cases, you may have some debt to pay off, or you might want to be more liquid, or you might want to invest that to grow your money even more so into your retirement years. So it's always wise to dig into the real discussion of where you should put that money. In scenario B, we're going to talk about leveraging the move up, not just to improve your net worth despite higher rates. We're going to talk about how you're going to uncuff your hands to that mortgage rate of 3%, let's call it, and sell the home, get the proceeds from the house to pay off the high yield credit cards or auto loans, things that are really high balance and maybe putting you at a monthly strain on your cash flow. So again, if you fall under the exemption rule and you take that money, you pay off the debt, you may end up finding that even though you're moving up, you're establishing maybe a higher loan, you're also establishing it at a higher interest rate. If you look at the fact that you've eliminated all that debt with the high payments, the high rates, you may end up being better off on a monthly basis in terms of cash flow, and you have all your debt paid off and there's no stress. Okay, now that you're ready to either move up or move down, buy a new house, one of the things that you may run into is having to move quickly on buying the new home before you sell your current home, or it might just be to be more competitive in a non-contingent situation. Maybe it's not a quick sale, but you want to show that you don't necessarily need to sell the home in order to buy the new home. So what we're essentially talking about is bridging the equity from the old home to the new home so that you can put your down payment and pay your closing costs on the new home. The bridge financing or bridge loan is set up in a 6 to 12 month time frame, so it's a short-term loan giving you that much time to sell your home and then pay the bridge loan off. And they generally are around 2% above prime. So today 6.75% is prime, so your rate on a bridge loan would be 8.75%, somewhere in that neighborhood. And they go up to 80% financing. So you'd have to have 20% equity in your old home after the bridge loan. Sometimes they require you to have more than that, maybe go to 70% or 60% financing, but it really just depends on the product that you're talking about. So let's talk about the pros and cons of a bridge loan. On the pro side, again, being more competitive, being non-contingent on the sale in order to buy the new home, that could be a situation where you're putting your best foot forward so you can win that contract. The other thing that we are able to do with a bridge loan is move very quickly on that in a 2-week time frame roughly to get that funding in place. And it also allows you to be more flexible on the sale of your old home. So taking your time, buying the new house, taking your time so that you can clean the old house up, stage it properly, and you're not living in a construction zone if there is some major work that needs to be done before you put it on the market for sale. So it gives you a lot of flexibility there. Some of the cons are it is a higher interest rate, and there are some fees that are associated with these bridge loans because they're very short-term loans. The only real way for the lender to get any profit on these type of loans is to build all that profit up front because they're not really going to be collecting a lot of interest over time. Some of the risks are is that if you can't sell the home within that 12-month period of time, there are some options, but there is, certainly some risk there as associated with the type of bridge loan that you get. And it's collateral, so it's securing it against that property, which really isn't a big deal because you're going to eventually sell that property anyway. So, given the cost of a bridge loan, if you can help it, and you're maybe 2, 3, 4 months away from thinking about buying a home, why not at this point get a home equity line of credit in place on your loan? So instead of doing a bridge loan where you would have to pay the cost and have a higher interest rate, go in and getting a home equity line of credit established on your home. Well, nice thing about these home equity lines of credit is that you're not paying interest on it unless you're using it. There are some upfront fees associated with getting the home equity line of credit in place, but a much better alternative than the bridge financing. And you could do that either home equity line of credit or a home equity loan. The lines of credit are better because you don't have to draw off of that line of credit until you need it. Maybe you never need it if you don't have to do this quick close or be non-contingent and have to buy the new home before you sell the old home. And the home equity loan, you have to take that money out. It's fixed. You have to make payments on it. You have to pay the interest on it. The other way that you could look at this instead of a bridge loan, when you get to the point where you're going to be buying a home, perhaps you have enough liquidity in other accounts, savings account, checking account, and then maximizing the level of financing that you can put on the new home. So instead of doing a bridge on the old home, just establish maximum financing on the new home, supplemented with some liquidity that you have sitting on the sidelines and checking or savings, and do what's called an 80-10-10. So an 80% first mortgage, a 10% second mortgage, and a 10% down payment plus closing costs. Or it could be an 80-15-5. So you're only on the hook for 5% plus closing out of pocket. And then once you sell the house, you can take the equity from the home. You can pay off that secondary loan, whether it be a home equity line of credit or home equity loan, and also replenish the checking and savings account. So, coming full circle on this, clarity is the biggest thing that you have to consider when we're talking about moving up and moving down. What is the net worth impact of the decision that you're going to make? It does this move accelerate asset building? Liquidity, does this free up cash for life events and retirement? Risk tolerance, can you handle the bridge period? And also cash flow, total financial impact, mortgage plus maintenance plus debt service. So we want to look at all of these things as we try to bring clarity to what's the best thing that you should be considering buying up, buying down, or staying put. So what we encourage you to do is stop guessing, start modeling. We use a system called Misely that can help you compare these options side by side. And at the end of the day, if the conclusion is that the low rate that you have on your home and staying put in that home is the best decision, at least you were able to see the financial impact of all the decisions. Most of us out there will be surprised to know that downsizing and getting rid of that rate, or upscaling and getting rid of the old rate, is probably going to have a greater financial impact one way or the other. But it's always good to start modeling this and get a lot of clarity, as I said on the last slide, about how this will impact you. So let's walk through a move down scenario. Let's say that this is a couple who is empty nesting. All their children are gone on their own paths, and now they have too big of a place, a $1.4 million home, and they are feeling like that's a bit too big, but they have this nice, juicy interest rate of 2.625 on their home, and they're not willing to give that up. They're feeling like they're handcuffed to that rate, but they don't need this big home. And they're thinking, to downsize, but it probably doesn't make sense because it will eliminate that 2.625% rate and potentially make them go to a higher rate, in this case 6.75%. So the theory here is, if you were to downsize into an $800,000 home, the cash amount that you would need if you only put 20% down and finance 80% would be 181,355 in this scenario, with a payment of 5334. Now, I recognize that the payment has jumped here because we're going from financing 456,000 and some change to 640,000. We're going to a higher interest rate as well. But here's the thing: in the earning years, which is in this case still a couple that's working and they're not yet retired, they can afford this 5334 payment and then take the remainder of the equity that they're pulling out of this $1.4 million home and putting that to work for them in the market. So if I go over to this analyze screen, you'll see that even though the payment is higher, you're still going to accumulate about the same amount of wealth between the equity that you have in your home and the investments that you have in the stock market, in other things that you're sending to your financial planner. On the flip side, if you stay in the $1.4 million home, you're going to have more equity, but you're going to have a lot less liquidity, a lot less cash to work with going into retirement. Let's say you're going into retirement in 10 years, but you were able to put that extra cash that you took out of the home after putting the down payment and closing costs into the new home. You're earning 7.5% on that over that 10-year period of time. That's going to accumulate to $1.4 million worth of investment. So if I go into the little bit more of the details, as you can see, $181,000 out of pocket for the down payment. $850,000 is the sales proceeds outside of the down payment that's going to be going into the investment account at 7.5%. That'll get you interest earned on that money of $754,273 over that 10-year time frame for the $1.4 million versus having the lower payment. So you have some payment savings if you were to stay where you are. You have a good low rate and low payment. But at 7.5%, the interest earned on that's only 118,000 and some change. So you're left with only 350 some odd dollars in liquidity that you're going into retirement for. Now, obviously, the equity on the larger home at 3% is going to net you a bigger number, but it's locked into the home. You don't have it available. So, given this scenario, there, don't lock yourself into the low rate, because at the end of the day, if you're getting 7.5% over 10 years, your net worth between equity and investments the same thing, if not higher, but you have more liquidity going into retirement years. And to make this even bigger point is, in that 10th year, you will actually have, if you go to this 10-year timeline, you will actually have enough money, obviously, to pay off your loan. So You could be debt free, pay that $545,000 off, be debt free, but still be left with almost $1 million in liquidity. So, in this example, we're going to talk about the move up scenario. And this is a couple who have accumulated some debt. They might have student loans, auto loans, revolving accounts, but they do have a very low interest rate on their mortgage. So, $850,000 is what their home is worth. They're paying 59.47 between paying off their current mortgage at 4.25%, plus they've got $100,000 worth of debt that is averaging around 12% on the interest that they're getting charged on this debt. So if you look at the payment breakdown, 244.8 on the first mortgage, 2,224 on all the debt payments, plus taxes and insurance and so forth, puts you at that 59.47. So if you look at selling the home, paying off the debt, and then using the remainder to put the money down on the new house plus closing costs on $1 million home, you're financing $800,000 at 6.25%. You're not that far away in terms of how much you're increasing your payment. So in this scenario, you're paying off debt that's converting to upscaling your home. And if you look at the over time value of that property on the move up scenario, you're looking at, let's go out 10 years of having a value of $1.3 million on that home versus if you're staying in the current home in the 10 years, you will have $1.1 million. Dollars. Have a lower loan amount, but you'd also probably at this point wouldn't have paid off all that debt. Here's some final takeaways. Number one, your home is a financial tool, not just a place you live. Number two, equity is only useful if it's deployed effectively, whether you're moving up, moving down, or reinvesting. Number three, don't let tax fears or logistic gaps paralyze you. Use the exclusions and bridge loans to solve them. And last but not least, confidence comes from clarity.